everybody. Welcome to Friday, another Talk Money with Tom show. Thank you for coming today. Kind of a big week, really, with the market having a hard time and what have you. So we'll be discussing that and kind of talking about what we see. But this show is about, how to improve your retirement, really financially. And really we focus on, the aspects of money management. And, we'll talk about that today in our summary, retirement planning. And tax planning, all really important subjects, I think, in order to have a good retirement. Whether you're already retired or heading in that direction, these are important points to learn about, even if you have an advisor. It'll help you, I think. So we started this channel. You can, send in questions now, and we can answer those questions, live on the show. I would love to do that. You can send them in two ways: email, ask Tom, talkmoneywithtom.com, or put them into the chat, and we'll look at them there. And of course, you can subscribe to the channel. We have over 1,500 videos now on the channel, so there's lots of resources there. You can dig through, find some of the past content. But when you subscribe, you can also hit the bell and get notified when we put new content out, so you can kind of keep up and see what's happening. I do a video every day on what happened with the market. Although I will not be doing the video Monday and Tuesday of next week. I'll actually be out of town, but almost every day. And then, of course, we do this live show on Fridays. So I think it's a great resource. It's a great way to start to catch up, and learn some different things about retirement planning. And then lastly, of course, if you like, you can just ask us questions, in a live format where you just meet with us. And so there's a book appointment button up in the corner of our website. The link for the website is on this page. And you can set a 30-minute time to visit with Ethan and I on phone or in office or video or whatever works best for you. So I appreciate everybody coming. I hope everybody gets something out of this as far as that goes. I do like to start off every show with a summary of kind of what I saw happening with the market this week. And so it's been a pretty active week, actually. Matter of fact, it's been down every day this week. It was down last Friday, too, so 6 days in a row. It's down today. And so let me share a chart, and we'll start with that. Okay. So really, obviously, this week we have a couple of main pieces that are driving the market. The market, even before this Middle East tension really became an issue, I think last Friday was when it really seemed to kind of hit. We are already starting to see some downturn, some flattening of this big run-up and what have you. So a couple of things. I always say this. I think this is really important. The market doesn't go straight up forever. And when it does go up more than normal, it generally does pull back. That's kind of how it works. You can see it in the chart. You can see all the bumpiness on the way up, especially, right? It's just kind of how it works. Now, sometimes, there's news we can attach to it. So we can attach the Middle East tensions and really the resurgence, or at least small resurgence of inflation, right? And so, let's cover those, and then we'll talk about kind of what we see happening here. So first of all, let's talk about the Middle East tension. And I just want to put a caveat in here because I've gotten some pushback a couple of times about this. Wars or invasions or, these geopolitical conflicts or military, conflicts are, I think, they supersede anything we're talking about in terms of the stock market and how it's going to react and what have you. However, the market looks at things kind of in a cold, hard way.
It's only about the money.
Yeah, it's about the money. And, obviously war is not just about the money, although sometimes that's a factor, obviously. But the market's looking at, how is this invasion or whatever is happening going to impact the economy, right?
And then the earnings and change.
Yeah. Because in the end, when you look at the market long term, the market has a pretty darn good record of going up, right? You look at, I think there's only one 10-year period and no 15-year periods, or maybe one where the market hasn't made money. And if you look at earnings, that's the key driver that drives these. So when you look at these conflicts, you always have to ask yourself, how will it impact earnings in the end, okay? So let's look at a couple of charts here, just some data. This one's a little bit dated, but I thought it was kind of interesting. These were a whole bunch of different geopolitical events and how the stock market reacted to that. And everything from Pearl Harbor to, the Iranian general that was killed in the airstrike back in 2020. So this is a little dated, but still kind of fascinating. What happened within one day? How far down did it go? So within one day, it dropped 1.2%. The ultimate drawdown on average was 5%. right? But a pretty good size range. I mean, Pearl Harbor dropped 19.8, right? So almost a bear market,
Yeah.
downturn after that. And so there's always this fear, but then, it hits its bottom on average in 22 days and then recovers within 47, right? So that's the norm. And this is kind of actually, I think, this chart, which I just pulled off of JP Morgan's site, actually an article that they wrote about, how the impact of geopolitical. This is pretty interesting. There's a whole bunch of different events there that are in that kind of gray squiggly lines, and it shows 12 months before and 24 months after, right? So here's the event. So if you look at the average, the market kind of shrugs these off, right? I mean, Ukraine's an example where the market looked at Ukraine, it dropped, in terms of the returns. And then, we're not talking about Ukraine anymore. We did for quite a while, even though it's still going on.
Mm-hmm.
And we still had this great market run and all these things that have happened, even while Ukraine has happened. So when you look at least the conflicts that we're having now, you have to look at oil, right? It's the one thing that can really have an impact on the economy. It can impact company earnings, and especially in an environment where we already have inflation that's above target, because it can push the inflation up even further, which makes the Federal Reserve raise rates even more, which makes it more expensive to operate businesses, more expensive to borrow money for consumers. Consumers spend less. You end up with more recessionary chances, right? This whole kickoff. And so this again came out of the JP Morgan article. Just oil prices are still relatively low. If you look back, it went to $130 a barrel, right? Right as the Ukraine situation unfolded. And the reason that was because Russia had 11% of the world's oil production at the time. Mm-hmm. And so there's a fear that if you take that oil production offline completely, you're going to end up with, very high oil prices. And I read some articles talking about $260 a barrel oil, which would have been wildly inflationary, at that time. And again, we were dealing with inflation at the beginning of 2022 as much as we are now, even more so to a certain degree. So, but what we have found with oil, interestingly enough, first of all, is a lot of that Russian oil kind of is still getting out there in different formats as far as that goes. But also the U.S. produces a lot of oil. And so we were able to kind of bring some more oil onto the, we're net exporters now, which is not a normal scenario for my lifetime. It's kind of, a newish development. We're net exporters. We're able to bring stuff. And there's a thing called demand destruction. So when oil gets really high, people cut back. Europe cut back. They came up with all kinds of different ways to get around, the oil problems that they were having because they were getting a lot of supply from Russia. We were supposed to have a really wild winter in Europe because the Russian oil was being cut off. Turned out to not be true because of cutbacks, U.S. oil, natural gas, these other things that they were able to find. And so demand destruction happens when oil prices get too high. And when we were talking about this earlier, you made a good point that, OPEC is, trying to control the price of oil as far as what they're doing in production. But when it gets really high, some of these countries might, decide to produce more at that price.
If oil reaches a certain point, countries will turn on the taps.
Yeah, exactly. And that brings down the price again. So it's something to watch. It's definitely on an uptrend right now, right? But at this current price at around $88 a barrel, that is not a problem for the economy. It's not a problem for earnings and what have you too. So, we just had we've had back and forth between Israel and Iran, obviously, and Israel sent in, another strike. And so we'll see how Iran reacts to that and what have you too. And these are important things. I would say the thing that hasn't happened in any of these conflicts is some kind of nuclear conflict, right? So that's always out there, and that can have some really unknown consequences in terms of the economy and earnings. So we'll see how this plays out, but hopefully things work out okay as far as that goes. But that's probably the number one reason the market's down, the last 6 days in a row is just kind of this ongoing conflict. However, at the same time, we've had the Federal Reserve out in force all week long. Man, there's been Jay Powell, Williams, the president for New York, the president for Minneapolis, Bostic, the president for Atlanta, et cetera, et cetera, et cetera, have been coming out and talking about basically leaving the rates up for longer. And then Williams yesterday mentioned that, hey, it's not a base case, but we could even raise rates. So that's the first time we heard that concept. Now, we've been talking about the fact that we don't think rates might not drop for the whole year.
Yeah.
And that seems to be a new development for the market and is trying to deal with that. This is a market that felt rates were going to come down, six times this year. Well, this is the core PCE price index, okay, year over year. So we compare, let's say, this March versus last March of last year. And core PCE, again, is what the Fed is looking at when they want to get to 2%. This is the chart for the last year. That doesn't look that bad.
Yeah, it's a pretty smooth descend down.
Yep. And we're at 2.78, okay? So the problem is that month over month. And so let's look at month over month. If you look at month over month, and again, a little hard to see this, but we've had a big spike here in the first quarter on a month over month basis. And more importantly, we had a very low month over month basis last quarter, in the fourth quarter of last year. And so that's what caused this market. So fourth quarter of last year, the actual annualized PCE, if you just took the fourth quarter, it would have come out to be 1.5%.
Yeah.
The Fed doesn't want 1.5% either. Matter of fact, they probably are a bit more afraid of 1.5 or lower than they are of 2.78. And so they started talking, I think, very nicely, talking about rate cuts, putting rate cuts into the dot plots, never saying anything about raising rates or, any of those things. And then we get this first quarter, and all of a sudden we get a jump in, this month over month, and inflation gets a little bit hotter. And now we have the Federal Reserve coming out talking very aggressively, maybe we'll even raise rates. And, Bostic, who's actually a guy that likes to cut rates, is now down to just one rate cut at the very end of the year. And so the market is kind of struggling with these two aspects. But again, if we look at a couple things, number one, look at the trend of the month over month for the past 3 years. Yeah, we're up, but this has happened all the way. Again, look at the yearly trend, right? Pretty good, even though we had this mess month over month. And so what I'm trying to point out is that it's not a straight line month over month.
Yeah.
It just isn't. And it's not a straight line quarter over quarter for that matter. So you're going to have quarters where it jumps up, and you're going to have quarters where it's lower than expected, and those types of things. And so we have to be really careful about getting wrapped up in that. And the market's definitely getting wrapped up in this. And we do, want to be careful about the overall trend. And the institutional memory that bothers the market the most is what happened in the 70s, where inflation was coming down very nicely, maybe something like this. And then all of a sudden, they started to lower rates and inflation got out of control.
Yeah.
Right. And so we're in this tipping point right now where the market's worried that, they might leave rates up too long, create a big recession, or they might lower rates and we get a resurgence of inflation. And all of this is revolving around the 70s, which was a very tough time.
No one wants that death spiral, essentially.
No. And in the 70s, we had high oil prices. Oil went from $4 in the 60s and 70s, from $4 to $40 a barrel, 10 times. It'd be like going from $88 to $880. Yeah, that would be bad, believe me. The world is completely different right now. There's a lot of other resources other than oil that can be used, and there is a lot of other products like even electric vehicles and what have you that are out there. So again, you get gas prices going up, you get kind of demand destruction. So there's the conflict piece that's driving the market down. Generally speaking, that's the initial response is the same. It comes down, and then the market starts shrugging it off. We'll see if that happens this time. Here's inflation, the other big bugaboo. Again, one quarter does not destroy this whole story as far as that goes. So you got to be careful of overreacting to what's happening to the market, especially when we look at kind of the primary trend. Okay, so the yellow line is the 50-day moving average. The blue line is the 200-day moving average. One of the pieces for us that denotes primary trend. So its primary trend is up or down. That's a huge deal. For us, we have two different trading systems. When primary trend is up, we generally will stay in the market and just use our list and the momentum on that list. So we'll buy the things that are moving up. We'll keep our core positions and we'll just keep in there and just keep going. And sometimes the things that are moving up on our list are more conservative, dividend paying stocks, utilities, even T-bill type things. And we'll move into those if they come up to the top. And so we can get more defensive, but we don't move in and out of the market when we're at a primary uptrend. Now, primary downtrend is when we start using our signals, right? So right now we've got a signal for stock at red, yellow, and red for Vaughan. But both of those are still in primary uptrend. So we're using the list. And what happens with the signals is when they change, we modify the list. So when it goes to yellow, we get rid of the more aggressive stuff off the list. When it goes to red, we get rid of even more aggressive stuff, and we're left with like ultra short-term bonds and T-bills. And we will make those moves because you can tell when the 2022 there, when the yellow became lower than the blue line, right? Yep. That's when you want to be really careful, because even though there's a lot of big run-ups, the lows kept getting lower and lower and lower. And if you look now, the lows are higher and higher and higher. Okay, very, very important to understand the primary trend and understand the primary trend and hang in there until that primary trend changes. Maybe you make some adjustments on a rotational basis, but you stay in the market. You look at that the arrow that happened before this last one that's happening right now. That was a great time to make sure you were still in the market. Right, that was October 27th. We were doing a show. The 72-year history of the survey that the Bank of America puts out for the big money managers. They had their lowest exposure to stock market at exactly the wrong time. All right, they're not paying attention to the primary direction. Right, they're doing shorter term trading, which is really, really hard to do. And they lost out possibly in November. Right after that, the market went up 8.9%. So got to hang in there. Couple other things to consider is just the market's kind of stretched out. Right over Easton's head there, we can see this RSI indicator, okay? And we can see, kind of where it was before, but right now it's getting quite low. When it gets low, here's some arrows that show kind of points. Now, the thing about this RSI indicator, it shows decent buy points. Sometimes they're outright, reversals, like October 27th. Yeah. A really good buy point. So this is when the market gets stretched too far to the downside, but not all of them work. I mean, one of them you can see was in the 2020 downturn. It was quite early. Yep. Market dropped about 20% after that. Quite a few of them were the beginning one in 2022 there, kind of the fourth one over from the right. Had a little jump, right? A couple days, and then back down. So, but I'm thinking we're getting stretched to the downside here. We're going to find some support. And I think this is my last point, and this is a really important portion. We're not going to stop this downturn until we get to support. It's too much momentum. It's too strong. And so the two big support points on the S&P 500, we got to 5250, 5240, something like that was the all-time high there. Yep. But 4,800 and 4,600, in that range, there's a lot of support. We spent a lot of time over the last few years in that range. And so if we get down to 4,800, that's a 9% drop from the high. If we get down to 4,600, that's a 14% drop from the high. That seems quite reasonable, considering how much run-up we've had and how much stretch. So you combine those support points with the RSI getting down to 30, I think we get a bounce here off that 4,800. We could get a bounce before that and then fall back down again to 4,800, because there is a big stretch going on and somebody's bound to come in and start buying here, maybe even next week. So sometimes it takes a little while for the whole thing to unwind before things kind of get going again. But there's no real reason, at least at this point, to be, bailing out of the market or making any major changes. You got to kind of stay in there, hang in there, watch for these different bounce points and see what happens. And because until proven otherwise, the primary direction is still up. And you can't trade, in my opinion, on the secondary. There's a primary is up. The secondary is what we're dealing with right now, right? This could be the beginning of a new primary downtrend, that's for sure, but you can't tell that now.
Yeah, it's too early.
Well, yeah, if you go back, look at how many times, if we go back to this one, look how many times you might have thought the primary trend was there's 5 there, including this one. Now, this one might be, but the other 4 were false. You needed to stay in on all of those. Yeah, until you get a new lower low, a 50-day moving average below the 200-day moving average, you still have to go with it work. Now, this primary and secondary, direction came from Charles Dow, right, who started the Dow average, right, started the Wall Street Journal, and from his writings, they developed this, kind of rules for trading, and this is going back to 1880. It's still pretty well known. I think it's an important component as far as that goes. There's a lot of news today about, or this week, about the market falling below the 50-day moving average, falling below
Yep.
that yellow line. Look how many times it's done it before, both ways. Went above, didn't matter, went below. That's not a great trading signal. Use that crossover. That's a pretty good trading signal, right? It's wrong sometimes. It's late all the time because it takes a while to develop. But you get into there, you get into the meat of the move, whether it's up or down. So to me, that's why they call it the golden cross and the death cross, right? When those happen. So we had the golden cross in February of last year. Pretty darn good point to be in the market. Yeah. So anyway, that's what's happening, at least in my opinion, for this week. Hang in there. This isn't a time to be panicking or what have you. Yeah, we all had higher values, a few weeks ago or what have you. That's okay too. If the primary direction stays intact, we'll get back to those higher values and we'll just keep on rolling. There's some things we can do to take advantage, just based on, what's happening with the rotation on our list, and we're doing those things now. But overall, you're going to want to hang in there on these particular market moves as far as that goes. So anyway, that's what's happening this week. Thank you for joining us. I look forward to kind of going over this again next week, and we'll see what's happening. All right, let's start with our first question.
So you've used the rubber band analogy for the recent run quite a bit. Would you ever sell a portion of your invested portfolio when it's in a stretched period and put that excess, that sold portion into like a money market that's paying 4 to 5% right now, and then buy back when the market hits an oversold point, kind of re-get back into the market?
It's a good question. Makes sense. So I talk about all the time that, you kind of, if you're going upwards, you can go up and up and up, and it just kind of stretches. And like a rubber band, there's more resistance the more you pull your rubber band, right? Or you can go the other way, pull downward, and you get more resistance where it's going to snap back up. Those are kind of smaller moves. Often talk about those in my daily videos. In terms of actual investing, when we do back testing, we have yet to find a significant methodology to do shorter term testing, shorter term trading, and we test a lot. We come up with lots of ideas. We have some very cool ways of doing these tests, and so it's very difficult to find things that happen on what we call the secondary move, really, or it could be part of the primary move, but it's very small. And so what you're trying to do then is you're saying, okay, for example, right now, the market is going up, the primary trend is up, and it gets overstretched. We take something off the table, right? And then we come back in when it gets overstretched to the downside, is kind of what we're asking there. And it's a good thought, actually. It just doesn't test out very well. And so I did put together a chart here of kind of this RSI index that we use, one of the things that we use to kind of denote stretch. And what I'm showing here is just the green arrows show when the market was overstretched, when you might want to come in, and the red arrows are when the market was overstretched to the upside and you might want to take something off the table. If you look at that, some of them are good, right? There are a couple of them in there where it worked out and you made some money on it, but some of them were really bad. So from middle of 2020 all the way to the end of 2021, you got killed there. The market made like 30 some odd % in that time frame, and you were in a money market for part of that time. Worked quite well there in 2022 in that one move. But if you look at the last trade that happened here, you would have had that piece. Let's just say it's some small piece, 2% of your portfolio, whatever. You would have had it out of the market. We'll use this stretch indicator to try to we're very interested in buying with new money when the stretch indicator, in this case the RSI, gets below 30. If I have new money coming in, like right now we have a freeze on new money until this thing gets to 30. It's at 31 right now. And we'll buy with that new money, because the buy points aren't terrible. In terms of a trading system in and out, it just doesn't test out well enough. You're better off sticking with kind of what we're doing, which has been working quite well, where you're in with your money on primary move, and you just realize that it's going to go up and down, right? It's part of the deal. And then you have a different system when the primary direction is down. And so, we have back tested, and we've realized that, you need to let things play out. The market's much easier to figure out over a longer term than it is over a shorter term. It's very erratic. It's a representation of human emotion, right? And so in the short term, that can be all over the place. In the longer term, the market actually makes more sense. It's earnings driven for the most part. And what events, so for example, here we've got this situation with the Middle East. We're pulling back based on that because there's fear, because we're humans and we're nervous about World War III starting and all the other implications that can happen. And the Middle East has been a scary place for my entire life, as far as I'm concerned, right? And so, how do you deal with that? Well, you often would want to take risk off the table because you feel like the world has become more risky, and so let's pull something off the table. However, in the longer term, the market will have to look at that and say, okay, how does it impact earnings? And if oil doesn't go skyrocketing, what have you, we probably brush this off at some point, even if it does turn into a bigger conflict. Assuming there's no nuclear thing or something that really scares people, this just becomes another conflict. The market jumped back during the Hamas situation, right?
Yep.
And then brushed it off and took off. The market jumped back during the Ukraine situation, brushed it off and took off. And again, I'm not talking about the impact of what's happening in these conflicts other than what it means to the stock market.
Yeah.
Right? I've been pushed back on that a few times. War is nasty and terrible, and you're talking about it in different ways. I don't disagree about how nasty and terrible it is, but my job is to kind of figure out what type of impact it has on the market. And logistically, the market looks at everything in terms of earnings ultimately. Mm-hmm. In the short term, we can have fear that drives the market down, and then greed comes in eventually and buys at those lower points. And I think that's what's going to happen here too. That's the most likely outcome. That's what's happened in the past, right? No doubt. Mm-hmm. So good question. But I think, doing the longer term trading, wait till, the 50-day moving average gets below the 200-day moving average. That has worked quite well. If you look at that historically, if you look at that from a chart standpoint, the stretch is very difficult to trade on. It's too erratic, and it doesn't really have, if I can't back test it and make it work better than the market, then and I can't. We've tested RSI and all these stretch indicators. They just don't have enough, performance to make it work. Our job, is, in my opinion, we charge a fee. So my job is to try to at least make up that fee by beating the market by our fee. If I can beat the market by more, great. Then the clients, so if I'm charging something and the clients get something, hey, more than that, then that's perfect. Everybody wins in that scenario. So again, what we have seen, in order to kind of beat the market in that regards, we have to do it with a longer term outlook, which means that we're going to suffer through some downturns. Mm-hmm. Yeah, like we did last year, dropped 10% from July 31st to October 27th. The market dropped. We didn't drop that much. We're not totally in the market, and we have 63% exposure to stock market, and the rest is in bonds and cash, just by chance across our entire portfolio with all of our clients. But it wasn't fun. But I'm glad we stayed in, because in November it went nuts and it went up, and we were really happy to be involved in that. So that's what we have to wait for here, because I think there's a tremendous amount of upward power still in this market. We can't really move out here based on this. I would be much more defensive if the 200-day moving average got above the 50-day moving average, and et cetera. The lows started to crack through to lower lows instead of higher lows, which is what we're having now. So, but it's a good question. All right, next question.
So this question came in. Has the ZEG or breadth indicator ever been wrong?
No, not since. Let's see, that one went back to World War II. I think we had 18 occurrences, and it was right 100% of the time. So the market was up 23% over the next 12 months. That indicator triggered in November of last year. So, let's see what happens November of this year. Happens to correlate with the fact that the market has historically gone up quite nicely in the third quarter of presidential election years. Yep. And in my experience, and I don't have data to back this up, but I would bet that if you looked at that and broke that down, the third quarter, a lot of that was close to the election, and so Yeah, I think that's still intact. There's nothing. That's not the only one either. We got a stack of them that have come
Yeah,
up
there are.
based on momentum indicators like the breadth indicator, and then there's that one 4 months in a row of upward motion, and you got this RSI um,
50.
above 50 for more than 80 days, right? Which we had more than that. We had over 100 days before it broke down below that. It was up, over a 2, 6, 9, 12-month basis. So, yeah, you got to take into consideration, though, always the one thing that's different. None of this data includes a pandemic.
Hmm.
It is the difference, and it's one of the things that's driving Wall Street crazy. Wall Street's still thinking we're going to have a big recession. At the beginning of this year, they're expecting 6 rate cuts. You don't have 6 rate cuts unless something's going on. And why are we having 6 rate cuts as a projection? Because Wall Street sees this huge increase in, you know, interest rates from basically 0 to 5.25, give or take, on Fed funds rate. We've got mortgages went from 3 to 7, right?
Yep.
All these things are happening. Credit card interest is going up. Things are costing more. You should have a recession. I don't have any problem with that. We didn't have one. Why? Because, as a matter of fact, we were supposed to have a huge recession and a
Yep.
giant drop for 2023, and we had a phenomenal up year. It was one of the best years I've seen. And why is that? Because we had a pandemic, and there was a lot of money pushed out to support that businesses and individuals during that pandemic, and some of that's still there, but nonetheless, it's a mentality. It's the same thing, in my opinion, in my reading, that drove the Roaring Twenties after the last pandemic, and so none of that is in these data sets. So that's still there too, and so that's what's making this kind of difficult. So you're going to see like this. I mean, Wall Street's selling off because, again, the market's run up a bunch, and we should be having a recession, and here it comes, and it's going to be caused by the Israel-Iran war, and oil's going to go to 260. And it's funny how many negative articles come out of the woodwork right now, even after a 5% downturn. It's incredible. And how many were coming out last year during that 10% downturn?
Yeah.
Oh, market's going to go. It's going to fall all the way down. We're going to hit a new low. We're going to pass up where it was at the end of 2022. And then the market goes up 8.9% in November, right? Because the pandemic, and because of the fact that earnings are still there, and some of this inflation is still being caused by a shortage of supply, because a lot of the inflation is coming out of the service sector, and we still have way more open jobs. I think it's like 1.6 or 1.7 open jobs to the number of people that are looking for work, right? The number of people that are employed, and that's a ratio that's extremely high still. So there's still a big need. You were telling me about the help wanted sign in a fast food restaurant.
Yeah, so I just went to this. It was basically a ghost kitchen, right? It was just they served food real quick. You just order. But they were having help wanted, and they were offering $26 an hour
Yeah,
for
and
a
so
cashier.
right, there's a lot of news about the $20 minimum. But here's a company that needed to pay $26 because what happens is, if I've got customers that are coming in, and they are, because man, rather eat out now. Spent 2 years eating at home or whatever it was. I'm better off paying somebody that much money than not being able to serve that customer.
Yeah,
Right?
the businesses are doing their calculation. As long
Yeah.
as they can make a profit,
Right.
they're gonna pay whatever they need to get those employees.
Yeah, and so, but that's inflationary. So if there was a 50 people lining up for that job, they wouldn't be paying $26 an hour. So we still have a shortage. We still have a shortage in the service areas, whether that's healthcare or education or restaurants and leisure, all of the travel. There's still a shortage of people, and that's kind of causing some of this inflationary pressure because that kitchen that's giving $26 an hour is probably going to have to raise prices if they haven't already and so we've seen some big increases in some of these areas. So anyway, that's it's a really interesting area as far as that goes, but that's what I see happening at this point. All right, what do we have for our next question?
With the current pullback, do you have any recommendations on changing your monthly investment or cash, or are you making any real adjustments to your strategy?
Now, the current pullback has not changed the primary direction,
Hmm.
and that's so important to understand. And so if the primary direction is up, we have two pieces of our portfolio, both on bonds and stock. The core, which makes up about 3/4 of it, and the target, which makes up the rest. And so when the primary direction is up, we are looking at these lists, these universe of ETFs that we have, and we're back testing those and finding, the ones that have the momentum that we want. So what we back test is what's the best time frame to look at? The last 10 days, the last 50 days. So we back test, we make these heat maps, and we try to figure that out. And then we try to figure out, okay, out of that list, let's say there's 180, let's say there's 20, whatever it is. We have 16 different universes. Where do we cut off? So in other words, when that ETF starts to fall below the other ones on that, say, 50-day average return, where do we sell it to move it up and buy the next one? And so those are two things that we're doing right now. That hasn't changed. That is the strategy for what we do during a primary direct up market. And so what you will see, though, is sometimes the more conservative stuff will start moving to the top of that list. And we'll start to move. And so we've moved into kind of T-bills for the target portion, the core portion of our bond portfolio, because bond's been, struggling for a while. And not because we're, the primary direction is still up in the bond market. It's getting closer to becoming down, but it's still up. And it's not because we are, moving out of the market. That's just what's doing the best. And so we'll continue to rotate. So we rotate, and we've made some changes. We've seen some pieces like cloud computing, which we did fantastic with. There's a First Trust cloud computing ticker symbol SKYY. I think we bought that last May, and then we sold it this year. Made a huge amount. It's been coming down a lot, right? So it fell past the cutoff line. We moved it up to something that was above the cutoff line that was moving, and that strategy at this point is all you want to do. You really don't want to be moving, too aggressively, one way or another. Now, if the primary direction turns and this downturn becomes big enough, and the 50-day moving average gets below, and we hit a low that is lower than the previous low, just for example, I'm using two just to keep things simple. There are other pieces to this, but nonetheless, then we switch and we start using these signals. And so right now, if you look at this bond signal, we'd be in T-bills, right? Because they're all red. If you look at the stock signals, we use those two, and we basically start to change the universe and cut back on the risk inside the universe when you're in this primary down, because we want to be really careful that we don't end up in the next Great Depression or the next 2008 downturn and ride that thing all the way down. But you have to give the market some room in these upturns, because what if we would have gotten out last year, right, between the end of July and the end of October, we would have missed out. Or even what if we got more conservative? We would have missed out on the 8.9% return that November brought. So I was very happy with how things work. We have back tested the heck out of this, actually, and it's not perfect. There's nothing even remotely perfect. Matter of fact, we're constantly having to back test and refine our targets and our cutoff lines and how far back we're looking, because the market's an evolving, animal as far as that goes. But I think strategy-wise, that's the way to go.
What about cash and basically monthly investments? Do you ever change those strategies? Do you hold cash now? What if I have I got a gift of $10,000? Do I just hold it in my bank account for now and wait till the market kind of is back in that upward trend, or do I just invest it now?
Yeah, I wouldn't be too objective vesting it now. We're at 31 on the RSI on the stretch index as far as that goes. I would probably be even more interested at like 4,800 on the S&P. There's a lot of resistance there. So what was resistance, which is now support. So we get down into that 48, 4,600. I'm a buyer. At least for those types of things. So. Yeah, it's kind of the same question we ask ourselves as new money comes in, right? We have new money coming in. We're not buying right this moment, just because, I think we're going to have some opportunities here to nibble on something at a little bit lower price. I already have a holding. That's a different scenario. I'm not going to trade in and out of that on a short-term basis, but I haven't bought yet. And one thing that's interesting for us as advisors is that we get a new client, let's say, for example, it's really important to try to have a good first impression. And so just throwing the money in as it comes in, sometimes, you get at that high point by chance. And the story I always tell is, I'll get a client who bought at some high point, and the market comes down. They think we're awful investors. I get another client that comes in at the bottom and it happens to go up. They think we're the best in the business. It's the same portfolio, the same strategy, same advisor. It's just chance. And so we do try to, be a little bit careful. So if you have some money right now, I probably would be waiting a little bit here. I'd like to see the RSI get below 30 if it's going to do so. The catalyst that can drive this back up is only one thing at this moment, because the Fed's not going to stop talking nasty. Nope. Matter of fact, that's going to keep continuing to get worse. And the situation in Israel and Iran, maybe it got a little better because the Israel response was somewhat muted.
Yep.
There seems to be some happiness about that. But let's see what Iran does. So I don't think those are going to go away anytime soon. But the earnings season's here, right? And unfortunately, when the market gets in a negative mood, you're going to have to blow them away to get them to turn their mentality. Because Netflix is a great example. I mean, they came out, I thought, with a pretty good earnings report, but they had some lower guidance than expected on revenue, and they got hammered. That's how it always works. If you happen to be a company that's coming out and announcing your earnings and your expectations for what you're going to see in the future, and the market's coming down or in a negative mood, you'll see this kind of sell-off happening in that stock. And so that's why I don't think that this downturn's over. I'd wait a little while to buy personally. I would really like to see a stretch below 30 at around 4,800. Those kind of are matching up a little bit, right? That would be a really good buy point. Might not be the low, but on a relative basis, when the market was at 52.50 and you're buying at 4,800, we're going to get back to 52.50. Might take a while, or what might not take a while. I don't know. The timing is hard. It's still not. It's a relatively good buy price.
Yeah. And I would, if you're having a monthly or investment or contribution, I wouldn't change that.
No.
Those strategies, you're thick and thin. You just ride those out.
Yeah, dollar cost averaging has been tested to the nth degree. It works pretty well. It's one of the key advantages of a 401k. You got money coming in every paycheck, right? That's coming in that 401k, buy. And it's almost like a dumb strategy, but it works quite well over a long period of time. And dollar cost averaging is definitely something. I agree with that 100%. Lump sums, maybe make some different choices. And 10,000, depends on how much that means to you, as to what you should do. But still, yeah.
So this question came in through email. What do you think about the changes to the FDIC insurance for accounts? So the change happened on, I believe it went into effect on April 1st. For trust accounts, essentially, each beneficiary of a trust account or trustee would have their own $250,000 FDIC insured, but the FDIC is now capping that at 5 people. So if you have a trust with 6 people, it's still capped at $1.25 million. So for that change, it doesn't apply to the majority of people. I'd say you'd have to have a big trust all in cash at a bank.
Yeah.
So a lot of people will not have that kind of money in cash at a bank. So it's affecting. So for the general population, I wouldn't worry about this change.
Yeah. Here, actually, it doesn't supersede my own personal advice, which is I wouldn't have more than $250,000 at any one institution anyway, period, irregardless of what they say. So, in today's world, I know you handle a lot of these. You can set up a brokerage account and buy brokerage CDs at a lot of different banks, all FDIC insured. You can get some decent rates, but that's maybe not the main thing. So if I had $1.25 million, I could buy 5 different CDs at 5 different banks on one statement. Super easy to transact those and what have you. The old days of running around to the bank with your passbook and moving money from one bank to another, that's still the most common way. But I wouldn't do that. I wouldn't have $1.25 million. Let's say I had 5 people in a trust. I wouldn't put $1.25 million at any one institution. Not because I feel like they're going to go out of business, or it's just a hassle when they do. How many people have lost money even in this last, when Silicon Valley Bank went out of business, 94% of depositors had more than $250,000.
Yeah.
Because a lot of businesses and what have you, right? So 94% of the money, and that was, and they still didn't lose money. And in the end, the government stepped up. But what if the government doesn't step up? So just spread your money across multiple institutions if you're going to, do that. And or, you can put that million a quarter into T-bills directly, or buy T-bill ETFs for a portion of that, where you have a direct obligation to the U.S. government, because if they fail, it doesn't. The banks will be gone already.
Yeah.
That doesn't matter. So I wouldn't worry too much about that change. It's a good question, and you can see what they're trying to do. They're setting it up so that they can cap their exposure,
Yeah.
right? Because I'm sure somebody's taken advantage of that and has 25 people in some kind of a trust and putting all this money there, and so they're just changing that rule. But yeah, I personally, it doesn't make a difference to me in my advice structure, where I've been advising my clients to not have more than $250,000 in any one institution.
Yeah, and it could be as simple as this. You have a bank that you like that's a physical bank, that you have checking and maybe a small savings account with, and then you have your emergency fund in a high yield savings bank that is maybe just an online bank only.
Yep.
That way you kind of split your money across two institutions. For your high yield savings, you get that best rate where you're having your emergency fund, but still accessible. And then with your regular big bank, your physical bank, you get all those benefits of having a physical bank. You can walk into ATM, you can go talk to a cashier if you need to. So you can kind of split those across different institutions based on your needs.
Yeah. Yeah. No, it's a good question. All right. Well, that's our show for today. Great interaction today. Love all the questions coming in. This show started in a big downturn. The first show, or the first video. I mean, the show started later, but the first video came out on the 22nd of March 2020. Market, was down 35%, give or take, at that point in time from the high, middle of the pandemic, and this is why we started this, so that we could have interaction with clients and others, just to try to settle things down. We do try to point out some of the things we think are being buried, because good news and positive news, affected inflation, yeah, it's having a little bit of a jump on the monthly basis, but it's not that bad. Or, these war situations historically have been shrugged off by the markets, and so that isn't always pointed out enough, in my opinion. Because I'm seeing about 10 to 1 right now, negative articles about what's happening with the market. So that's what this show is for. So thank you for sending your questions, but feel free to send in some more questions during the week. You can send those to asktom@talkmoneywithtom.com, and you can subscribe to our channel, and get notified when we put out new content. Again, I'm putting out content every single day for the most part. Again, I won't be putting out the Monday, Tuesday videos this week, next week, but in general, if you're curious about what's happening with the market, I can fill you in 2-3 minutes, video. It's pretty efficient. And obviously, then you can meet with us. If you have some real concerns and you're wondering about what's happening, and you're wondering what's happening with your money, either that we're managing, feel free to meet with us if we're not already, meeting with you coming up here shortly. Or obviously, if you're not a client of ours, and want to talk about what's happening, we can help you there too. We have strategies that that we've developed over the years that maybe could pay off for you too. So anyway, love everybody coming today. Thank you so much, and look forward to being able to talk to you again next week. Thank you.